Hello, Dan Passereli here, and today we're going to talk about Iron Condors, and this is called Iron Condors Explained because that's exactly what it's going to be. Now, before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading, and you can get a copy of that by calling 1-888-OPTIONS. So Iron Condors are a very common strategy. In fact, some people totally specialize in them. They're a very simple, versatile strategy. They can work in all market conditions, volatile or non-volatile. We'll talk more about that. And certain criteria have to be met in order to make them work well. So let's start on our material. In order to understand Iron Condors, the first thing we need to understand is credit spreads. And if that doesn't make sense to you just yet, it sure will very, very soon. So the first thing to know is that credit spreads are of two varieties. There are call credit spreads and there are put credit spreads. Call credit spreads are when I sell a call, typically an out of the money call, and I buy a higher strike call with the same expiration on the same underlying. So a put credit spread is when I sell a put, typically an out of the money put, and I buy a lower strike further out of the money put with the same expiration on the same underlying as well. Now, with both of these things, the short option is the meatier one that has more value. And therefore, that's why I'm collecting a credit, because I take in a bigger amount than what I put out. And the short option is the trade, and the long option is the insurance policy. If you think about them like that, it's going to be really, really beneficial. Each of those two options has its role. Now, this presentation isn't about credit spreads, so I'm going to kind of race through this so we can spend the rest of our time all on Iron Condors. All right, so an Iron Condor is best set up as such. We're going to start with a call credit spread is set up as such. The first thing that I look at is resistance. Okay, and we've got a little bit of resistance here. We've got a little bit of a trend line here. And what does that mean? That's an area where we think the stock might not go up above, right? Why is that beneficial with credit spread, with call credit spreads? Because we don't want the stock to go up above that strike price. So what we're going to do is we're going to sell a call that has a higher, a strike that's either at or above resistance. Next thing we want to do is look at implied volatility, and we want to make sure implied volatility is at least somewhat elevated. We'll talk about that more under the Iron Condor section. So here, if resistance was at around 30, I could sell the 30 strike calls and at the same time buy the 32.5 strike calls, collecting a total of 27 cents. And so here, let's see who's experienced here with trading credit spreads to start with. If I sell the 30 calls, buy the 32.5 calls and collect 20 cents, hold this all the way until expiration, and the stock is below 30, what's the most I can make on this trade? Go ahead and hit that chat box. What is the most I can make on this trade? Boom, Tony says 27 cents. Nice. Frank says 27 cents. Scott says 27 cents. You guys are on fire. I love it. I love it. I love it. I love it. Great job. Great job. Okay, so let's see. This credit spread is $2.50 wide, right? Because I'm selling the 30s and I'm buying the 32.5s. 32.5 minus 30 is $2.50. What's the most I can lose on this spread? If I hold it and the worst scenario happens, the stock rises up and is above 32.5 at expiration, what is the most I can lose? Boom, look at that. Jim, right on the darn money, can lose $2.23, right? Because it's $2.50 minus 27 cents. Great job. Great job, great job, great job. Ronald got it, Dina got it. Awesome, you guys are fantastic. Okay, so that's pretty easy, right? How about put credit spreads? Well, this is a screenshot I took literally just earlier today in Netflix. We've got some support down here at this level. What is this, like the 350 level, basically, right? Implied volatility slightly elevated. Again, we'll talk about that more later. So we could sell the, it's behind my other monitor here, the 345 puts and buy the 340 puts and collect $1.20. So this is, let's see here, $5 wide. So basically, if the stock stays above 345 between now and expiration, both options would expire worthless. The most I can make is the $1.20 that I collected. Most I can lose is $3.80. Sounds like a number of you got this down pat. If you don't, that's okay, because we're going to go a whole bunch slower when it comes to Iron Condors. And by the way, why the heck am I talking about credit spreads when this presentation is supposed to be about Iron Condors? Well, guess what? When it comes to Iron Condors, there is a big secret. Shh. Do you know what it is? It's a big secret. I don't want you to tell anybody, okay? Are we all on the same page? Is this just between me and you, right? Well, I'm going to tell you what the big secret is. Iron Condors are just simply two credit spreads. That's all they are. A call credit spread and a put credit spread put on at the exact same time on the same underlying stock or ETF in the same expiration. Very, very simple. They're both out of the money. The stock is between, right in the middle of all the strike prices. So I've got good news and I've got good news. If you already understand credit spreads, you already understand Iron Condors. But I'm going to help you understand them better. If you don't yet understand credit spreads, then guess what? I'm about to give you a crash course in Iron Condors, and so you're going to have 3 strategies down pat instead of just 1. Does that sound great to everybody? Give me a yes if that sounds great. Hit that chat box. Give me a big old yes if that sounds pretty darn sweet. Les and Dean and Susie and Brian and TJ, holy cow. All right, I like it. You guys are excited? I'm excited. Let's do that. This is better than going to the track. Yeah, I think it just might be. All right, Danny, peas and carrots. Thank you. Yes. All right. So here's how this works with Iron Condors, because, okay, so with call credit spreads, we're looking for a stock that has some resistance, some technical indication that the stock might not rise above a certain level. With put credit spreads, we have support. We have some technical indication that the stock might not fall below a certain level. So in Iron Condor, we want both. We want a stock that has support and resistance at the same time. It's a stock that's called range bound, or trading in a channel, or trading sideways. All these are basically synonymous, right? So that's the first thing that we look for. The next thing that we look for is implied volatility to be elevated. Now, okay, let's give a little crash course on implied volatility here. What's implied volatility? Implied volatility is basically, in its simplest terms, a measure of how cheap or expensive options are, right? If implied volatility goes up, the options are getting more expensive, all else held constant. If implied volatility is going down, the options are getting cheaper, all else held constant. That's it. And so in order to read volatility, I'm going to give you a crash. In fact, not only, okay, so you signed up here today to get one strategy down. You're going to get 3 strategies down, and you're going to learn implied volatility analysis. Holy cow. You guys are getting more than you bargained for. We should have charged quadruple for what you paid to get in this class, right? Okay, so look, let's get serious now. The implied volatility, all right, the implied volatility, we're going to start with the chart and then explain with the chain. All right, remember that. Start with the chart, explain with the chain. So let me show you exactly how this works. Tony said, so a stock that's not very volatile, so a stock that's pretty sideways. Well, yes, but it can be in a volatile range as well. That's the beauty of this. I said this can work in any market, and I mean it. We don't have to have a boring market, because look, when implied volatility goes up, it's usually because the market's more volatile. That means we collect more on our Iron Condor. When the market's barely trading at all, that's when the implied volatility tends to go down, and we collect very little on Iron Condor. So if you understand implied volatility, you can trade these in any market, volatile or non-volatile. Okay, so stick with me till the end and keep watching. You're going to get this. You're going to love this. So this is a screenshot I literally took earlier today in IWM. Now, IWM has had a bit of a range lately. I mean, let's see here, $10. This is a 10% range, about 5% down from here and about 5% up from here. That's a, that's a reasonably big range, I guess. I mean, it's not that big of a range. It tends to feel like the market's been even more volatile than that. But here's the thing, implied volatility rose quite a bit lately. So let's do this step by step. Do we see a channel towards the right side of the chart? Yes. There's support at $190. There's resistance at about $210. Okay. And by the way, any questions you have, I'm going to save till the end. So let's keep questions and comments, let's keep comments, not very numerous. And let's hold, you can ask questions now, but I'm going to hold until the end so we don't get off track. We've got support at 190. We've got resistance at 210. And then we've got our implied volatility and historical volatility down here. So the blue line is historical volatility. That's how much the underlying stock has moved around lately. The red line is implied volatility. That's how cheap or expensive the options have been lately. Okay. So as you can see, as of, well, I guess this is maybe 2 days ago, the implied volatility is way above historical and in the top, at the very top of the last 6 months range. So those are some indications that implied volatility was potentially a little expensive a couple of days ago. Now it's come down a bit since then, but it's still maybe in the top half of the 6 month range. Just kind of eyeballing it. Yeah, probably in the top half of the 6 month range for sure. And it's above historical. So even though it's come down from a pretty dramatic high, it might still be a little high. But here's the thing. Here's the thing where a lot of people who, get started in implied volatility, but they don't really immerse themselves in it, they stop a little bit short of the analysis that's necessary. We start with the chart, explain with the chain. The chart says implied volatility may be a little expensive. If we go to the option chain, here's what we're going to do. We're going to first model out, okay? We're going to model out in Iron Condor where the short strikes are at or beyond the support and resistance levels. So for the support level, that was at 190. We're going to model out selling the 190 puts, as you can see down here at the bottom. This is my Thinkorswim platform. Selling the 190 puts, buying the 189 puts. And then we're gonna, because resistance was at 210, we're gonna model out selling the 210 calls, buying the 211 calls. So we're gonna take in a total of 26 cents if we make this trade, but do we wanna make this trade? Well, if we go back here to look at what the historical volatility is, it's 29.5. We can sell on the 190 puts a 41.33 volatility, way above historical. On the calls, we can sell at 29.8, a little above historical. So we explain with the chain. We start with the chart to see where historical volatility, if in general, the trade is like the implied volatility is above historical, but then we're going to look at, then we're going to look at the exact options we trade. So JQ, so I don't want to comment on a lot of comments here, but JQ makes a hilarious statement. A lot of work to collect 26 cents. JQ, you should try doing physical labor. Okay, this is not hard work. This is fun work. You're sitting in front of your computer figuring out ways to beat the market. Go work a jackhammer for a month. Right? I'm half kidding. But no, like honestly, like look, the thing is I'm modeling out a one lot, 26 cents. Whoop-de-doo, right? Well, 26 cents is $26 of actual money. This is a one lot. Nobody's going to trade a one lot on this. You might trade a 10 lot, which is $260. You know, if you have a bigger account, maybe a 50 lot, which is, what is that, $1,200 something or dollars, right? So like, this is a powerful darn strategy. And I've got another example, by the way, where, but I mean, you know, like definitely not taking away from your point too, because when we're using smaller dollar amount things like this, we want to take into account commissions, right? So, you know, you do make a little bit of a good point here, and we want to be conscious of that. So depending on your commission structure too, some of these low dollar ones might be a little tricky. So we always want to think about that. Jay, and again, I don't want to get hung up on questions, but this one is a little bit relevant to what we're saying. How do you select the strike prices? Either at or above resistance on the call side, at or below support on the downside. And during the Q&A portion, I'm going to expand greatly on that, but I want to make sure we're staying on track and that we're getting everything done that we need to. Yeah, more contracts means more fees and commissions, and it also means more profits. You know, if your fees make up half your trade, it's silly. In this case, my fee makes up 10, not even 10% of my trade. It matters, but you know. All right, so I'm going to kind of take my eyes off the chat box for a little bit now. So if I don't get to your comment or question, it's intentional. All right. So a couple of really important points here. Relative to the strike width, we want to make sure we're collecting enough premium. My rule for any individual credit spread is I want to collect 10% of the strike width. So these are the put credit spread is the 190, 189. That's $1. Needs taking at least 10 cents on that. The 210, 211 call spread is $1. Want to take in at least 10 cents on that. When it comes to Iron Condors, it could be okay if I take in 8 or 9 cents on one, as long as I'm taking in, you know, 11 or 12 cents on the other. I like to see at least 20 cents, you know, I like to see at least 20% of the strike width, presuming I have a balanced Iron Condor, which means the call credit spread and the put credit spread are the same width. And Avon, I do not use delta. That's one of the most gigantic fallacies in all of option trading, is to use deltas to set your strikes. I don't know who propagates that madness, but it doesn't make sense. The reason you don't use delta is because the smaller your delta, the premium, the lower the premium you take in. The higher your delta, the higher the premium you take in. So that means that your chances of success is exactly, like that is the whole purpose of the option pricing model. Your chance of success on the trade is exactly congruent with your risk reward ratio. If I were to instead do like the 195, 205, you know, a dollar wide, I would take in, what is this, about 30 cents here and 25 cents here. I'd take in about 70 cents and it's only a dollar wide. So I'd make 70 cents and lose only $1.30. Or no, I take in, oh, wow, I take in 70 cents and only lose 30 cents. An immensely better risk reward ratio, right? But if you look at delta's chance of success, my chance of success isn't as good. So yeah, using delta is, you know, it's when you're first learning options and you don't have anything else to go off, okay, use it so that you get in the habit of looking at delta and that kind of thing. But as you get more experience, you're going to use things that can actually help you. You know, delta guarantees that no strike price is better or worse than any others. Basically, that's what the options pricing model does. So I'm glad that somebody brought that up. So we only use support and resistance if we want to get an edge on the market, right? Okay, so that said, a couple other really special things to take note of here. So if we were only doing, okay, so our maximum profit is reached if we're between 190 and 210. So that's a pretty broad range. Now this expires in 7 days, 1 week. As long as we don't fall 5% or rise 5% in 1 week, we have a winning trade. Now, don't get me wrong. I'm not saying this is some guaranteed trade. This is a trade where we're playing the odds, right? And I'm also just using this trade as an example. This is a pretty good trade. It's not the best trade I've ever seen, but we haven't really been outside that value in, oops, hold on. How do I get back here? I mean, we haven't really been outside. I mean, we kind of kissed outside this range 1, 2, 3, 4, 5, 6, 7, 8, 9, almost 2 weeks ago. And then the last time before that we were outside of this range was about 3 weeks before that. So even though like you can sit here and say, oh, 5%, I mean, this market can move 2% a day, and it can. But the chart tells the story, right? We've only very briefly been outside that range twice in the last almost 2 months. So that is why we, that's why we look for those support and resistance lines. So as long as the stock stays between 190 and 210 by expiration, and just imagine we hold this all the way until expiration, which we'll talk about more in a minute, and we let it expire, right? Then all these options would, if we're between 190 and 210, all these options would expire at expiration, and that 26 cents, which is $26 of cash, time for just one contract times the number of contracts we sell, we get to keep, right? Which is nice. That's our best case scenario. And looking at the chart, our chances of that being a success is probably a lot better than what Delta would tell you it is, right? Another reason why we don't use Delta, it's not technically actually mathematically accurate. If we go outside of that range, the most we can lose is 24 cents or $24 per contract. So it's basically like we're risking 3 to make 1, right? But here's sort of the magic. Can this stock go too high and cause us to lose money? Yes, can it? Give me a yes in the chat box. Can the stock go too high and cause us to lose money? Yes? Okay, there's our yeses. Can the stock go too low and cause us to lose money? Yes? Yes. Okay. Third question. Can both of those things happen at the same time? No, they can't. So there's a little bit of kind of magic here that happens with an Iron Condor. If we just sold just the credit spread, we would collect, or just the one of the credit spreads, say the call credit spread, we'd collect about half of this. Let's just say exactly half. We'd collect 13 cents. That means our maximum profit would be 13 cents. That means our maximum loss would be 87 cents. So we'd make less and lose more. We could only lose if it goes up. If it goes down, that's okay, but we'd make less and lose more. If we only did the put side of this, we'd collect, say, 13 cents. Most we could make is 13 cents. Most we could lose at 87 cents. So we'd collect, we'd win less and lose more. We could only lose if it goes down too much, but still. So when we do both of them, our profit kind of doubles. I mean, not kind of doubles, it basically doubles. And our risk, the most we can lose, becomes significantly less. Now we can lose if it goes up or down, but not on both. So there's definitely a little bit of a trade-off here, right? But there's a great deal of benefit we're getting as well. Does that all make sense? How long do you want the stock to be range bound for an optimal trade? And should the trade be less than 30 days to expiration? Okay, so two different related questions. I'll work backwards. We want the trade to be range bound for as long as we have this trade on, right? Like, duh, right? One thing that we know is that with near the money options, they tend to lose money at a faster rate with less time until expiration. And so, whoops, I didn't mean to do that. Let's pull that back up. Now, these are about 5% each way out of the money. But if, and I don't have my trading platform open because I don't do things like that live during webinars. But if I did, I would bet that, so this is just a 1 week option. Our other choice is like 2 days, and that's just not enough time. If we did a 2 week option, chances are our theta, which is our rate of time decay, would be lower. So basically what I'm saying is if we doubled the time until expiration, we wouldn't double our profit. Our profit would be less than double. So we would make more money if we sold, you know, if it worked out, we'd make more money if we sold a 1 week Iron Condor and then so after it expired, sold another 1 week Iron Condor. So now that said, I keep saying, hold it until it expires, hold it until it expires. We're almost never really going to want to do that. Never say never. There are times for everything. But at some point, the risk reward becomes not worth holding it anymore, right? Because right now, the most I can possibly make is 26 cents if I sell it at 26 cents. But after 6 days pass or something, and if this Iron Condor is trading for like 4 cents, the most I can make from that point forward is 4 more cents. Then it becomes, is it worth the risk of the market having a surprise move, which if you don't know that can happen, you've had your eyes closed for the past 2 weeks, well, 2 years, right? it becomes not worth holding on to anymore if the most I can make is 4 cents. That said, too, another thing that I like to do sometimes is I like to leg out. If the stock ends up kind of going down towards the put side, I might close the call side. If I can buy the call side back for a couple of pennies, I will. Right? Get rid of risk. You're like John Kamisic, who's our head coach with me. He always likes to say, you're a risk manager first. When you can take off a trade that no longer has good risk reward, you take it off. Trying to squeeze out every last penny ends up becoming a little bit silly. I'm going to hold some of these questions. And by the way, going forward, drop the questions in the Q&A ones so I don't have them in both chat and Q&A. So then we'll make sure everybody's question gets answered, right? Because that's the most important part of this presentation. Okay, let's look at a completely different example here. This is Ford Motor Company. And we look here the past, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, almost 1 month. In fact, now that I'm thinking about it, since those are trading days, that is 1 month. For the last 1 month, Ford has been between 16 and 18 and a quarter or something here, right? For a full month. Don't tell me what the delta is. I don't care what the delta is. I just know that there's support at 16 and resistance at 18 and a quarter. I also know that historical volatility is 55 and implied volatility is 60. So when we start with the chart, we see that implied is above historical and implied is in the top half of the 6-month range. So implied volatility might be expensive. We start with the chart, but we explain with the chain. So let's see here. Where was support? Support was at 16. Now we're a little bit closer to support and resistance, and somebody before was talking about Skew. I think you're talking about a different context that I'm about to bring up. We'll talk about your context in a minute, Wayne. But support was at 16. So I could sell the 16 puts and buy like the 15 puts. But what if I went out a little bit further and got a little bit more what I like to call wiggle room? I could sell the 15 and a half, 14 and a half put spread, and I could collect at least 13 cents on that. Sell these at 23, buy these at 10. Not even having to middle the market, because Ford's pretty liquid, right? Look at all this monstrous open interest. So I don't have to sell right at the strike. If I can ever get more wiggle room and sell farther away from the strike, in this case with the put, sell below support, sell my short strike below support, I'm making my trade even more likely to win. So now on the call side, resistance was about at 18 and a quarter. I couldn't really sell the 18 and a half, or yeah, the 18 and a half, 19 and a half spread. I could only sell that for about 3 cents. My rule is I want to try and get more than that. In a perfect world, if it was just a straight credit spread, I want to get 10% of that width, so at least a dime, and that's not enough. So I'm looking instead towards the 18, 19. Now, still here, I only take in about 8 cents, which is a little shy of my, naked credit spread rule. But when I'm combining that with the other credit spread, it's okay. And my break even is going to end up being just about exactly 18 and a quarter. So I'm okay with this. I don't love the call side. And to be fair, I'm really just sharing this with you as an example. I'm definitely not saying, hey, this is the best trade I've ever seen. Go out and trade it. This is a pretty good trade as of right now. I'm giving this presentation for those of you who are watching it live. When the market's closed, when the market opens tomorrow, trade might be better, might be worse. So You know, it really is just an example. Still, it's not really a bad trade. I like the put side a lot more, but it's not really a bad trade overall. So what's important here is let's go back to the historical volatility, which is 55.6%. I can sell the call volatility at about, let's see, which one am I selling? The 18 strike, 55.25. So just a smidge above historical, or basically right at historical, which is okay. The put side, the implied volatility is 63. So decidedly above historical. So we're able to get an edge. Basically, we're selling the spread for a little bit more than it should be worth because implied volatility is elevated. We get a benefit. So the idea here is if we were to hold this all the way until expiration, which we're not going to do, we'll take it off when the risk reward is no longer worth it. But if we held it all the way until expiration and the stock stayed between 15.5 and 18, and we let it expire, our maximum profit would be 23 cents, which is $23 of cash times the number of contracts you put on. The maximum loss here would be what? Well, these are $1 wide, so $1 minus 23 cents. Maximum loss would be 77 cents. So basically, again, we're risking 3 to make 1. And a good way to think about this is if I'm risking 3 to make 1, do I think that I have a better than 75% chance of winning? Do I? Let's go back to this chart. Do I think that over the next, how many days is this? 9 days, 8 days tomorrow morning. Do I think that there's a better than 75% chance of staying in this range for 1 more week? We've been in this range for a month. Do I think we'll stay within this range for 1 more week? And your answer might be yes. Your answer might be no. If your answer is yes, you like this trade. If your answer is no, you don't. But that's like one really quick and dirty way to think very clearly about these. Now, when are we going to take this off? Well, if I can buy back either credit spread for like a couple of pennies, and sometimes like let's imagine, so let's get really tactical here. Oh yeah, Jim says probably avoid earnings, and yeah, usually dividend events too. A lot of times they're not a big deal, but definitely avoid earnings. If it's a big dividend, yeah, I'm 100% with you. Really great comment. Now, sometimes, so like bear in mind that the call side of this, I only collected 8 cents. Sold this one at 13, bought this one at 5 cents in this example. Let's imagine a scenario where tomorrow morning Ford gaps lower. Maybe it gaps down from 1658 down to, 1590. Well, and we're getting closer to expiration. So time's passing. Theta is on the 18 calls, theta is 2 cents. So these that I sold at 13 will be worth 2 cents less. With the stock down another 50 cents, these will be worth about another 5 cents less, right? Well, let's see, what's our delta? Well, our delta says it'll be worth 9 cents less. So that's 11 cents less. If I can just buy the 18 calls back at 2 cents, I don't even care about buying the 19 calls at a penny. It'll probably cost me 50 cents, which is half a cent of option premium to buy them back. So I might not even care about buying them back for a penny. The important thing is that you close the short strike, because that's where you can get into trouble. Take your profit on the short strike and close it so your risk is gone. Make sense? It does, right? Or if the stock gaps up, we might be able to do that on the puts. The puts have a little bit more meat to them, so we might have to endure a couple more days of time passing to make them worth less for theta to be able to buy them back. But that's what we do. And heck, if we can buy both spreads or both short options back for a penny each, that's what I want to do. Take the risk off the table, get done with it. A half a penny of option premium, even per contract, it does add up a little bit on these smaller dollar amounts, but it's still very minuscule. It's still it's like your smallest cost of doing business, right? I mean, taxes, way bigger cost. Bid-ask spread, way bigger cost. Your electric bill is probably a bigger cost, right? It might be a stretch, but I know I've got 4 monitors here and I keep these suckers going all day long. Between that and bandwidth that I have to use, I need high-speed internet. Your commissions are probably the smallest cost you pay, right? Okay, so that said, with an Iron Condor, we set strikes at or outside support and resistance levels. For calls, at or above resistance. For puts, at or below support. We only sell if implied volatility is elevated. And I gave a pretty crash course on implied volatility. I've given some presentations for OptionsPlay on reading volatility and using it to get an edge. Go back through the archives. There is a trove of knowledge on the OptionsPlay site. Go back and, especially if you're, a subscriber, go back and look at some of the presentations. Find the one that I did on using volatility to get edge. It'll fill in any blanks that you have today of anything we talked about with volatility. Also, consider macro and microeconomic factors. Who was that? Jim, who said probably avoid earnings events. Yes, absolutely. Maybe avoid dividends too, because the stock opens, if it opens unchanged, it opens lower by the amount of the dividend the day after the X date. And sometimes that can push it down a little bit too low. So that's also good advice. Macro events. If there's a political event, armed conflict, just for example, that can is really moving the market that day, you might want to pull back on strategies like Iron Condors and wait it out, right? That said, that tends to boost implied volatility and make these option premiums more meaty, so I can sell them at a much bigger premium. And I can make my Iron Condors, I can take in more premium for the Iron Condors, which means my reward is better on them and my risk is less on them. So even in times like this right now, I mean, look, I did trade credit spreads this week. I traded at least 2 credit spreads this week. I'm trying to remember if there was a third one. And the market's been pretty volatile, but I'm taking advantage of that higher volatility, that meteor option premium. Do I like it when the markets are really calm and complacent? Yeah, I like that too. And I still look for overpriced volatility. The implied volatility would be lower then, but some of it can be overpriced. And manage your trades. Get that risk off the table when it's no longer makes sense for you. Tony says these trades are typically very short term, less than 30 days to expiration. Absolutely. Almost all of my trades are less than 30 days to expiration. Because if I'm selling options like I do with an Iron Condor, my theta is higher if it's less than 30 days to expiration. It just ends up being a smarter trade. If I'm buying options, they're overall cheaper. So even though my theta is higher, if I'm looking for a really big move, I can get a lot of gamma. I could get a very leveraged profit if I'm right with less than 30 days to expirations. So almost all my trades are. Oh, thanks, Ken. Appreciate that, my friend. Okay, so Wayne says, so I'm going to go through the questions in chat first, and I'm going to go through the ones in Q&A. Yeah, okay, I'm going to do it that way. So hang tight. I'm going to get as many as I can get answered as possible. If the short put or call gets breached within 5 days, how do we manage the trade? Should we roll aside? Great question. So there are things that can go wrong with this, obviously, right? If we go too high or too low, we can lose. So what does happen if we go through the short strike in the immediate future? Well, if we do, that's when I do one of two things. I either close the trade, which typically means closing, if it goes up too high through the call strike, probably the put strike I can take a nice profit on and I close that. But I also close the call side, but I might roll the call side higher. It depends. If there's more resistance up higher, sometimes I'll roll it. If it was just a big surprise move and there's no resistance above, and I'm like, wow, this could keep going, I don't know why this happened, I just close it. Even if I take a loss, it's okay. I mean, the more you trade, it'll be close to half your trades are losses. You keep those losses small and your profits big. That's a recipe for success. Good questions. What value of IV do you consider to be elevated? Here's what I consider. If today's implied is above today's historical, that's one indication it's elevated. If today's implied is in the top half of the 6-month range, that's another indication it's elevated. So, I mean, sometimes a high implied volatility could be 25. And sometimes a low volatility could be 50. It's all relative to itself. It's not absolute. Tony says, wouldn't you use OCO with an Iron Condor? Are you talking to get out, Tony? If you're talking to get out, no, because I would never use a stop on a spread. You end up getting a really terrible price. I always like to work my orders. So yeah, so I probably wouldn't. And it's definitely not a bad question. It's a good question. I see a lot of people do that and they can't figure out why they got such a terrible fill. And it's because you should never use stops with spreads. Wayne says, Dan, if we skew this Iron Condor, does that mean the width of one side is different from the other side? Or does that mean the two credit spread have different deltas? Well, Wayne, it depends what you mean by that. So, whoops, gosh darn it, I didn't mean to do that. I mean, one way to skew here, let's go to this one. One way to skew it is here, the stock is at 200. I'm selling the 210s, which is 10 bucks away, selling the 190 puts, which is 10 bucks away. It's very equidistant, not skewed. If the stock's at 205 and I did this, it would be skewed to the call side. I don't like to do that very much because then I've got more of a directional trade. It can't go up too much, but it can go down a lot. I'll do it sometimes. Sometimes you can do like a broken wing Iron Condor, but usually those are for very, very specific scenarios. So I usually like to keep them balanced. One strike is $1, the other strike is $1 wide. The stock is smack dab in the middle. That to me, that's the most common way that I do that. How long do you want the stock to be range bound? Okay, we already did that one. Forgive the almost obvious. The beauty also is that you will only incur the margin requirement of one side of the Iron Condor, not both. Yeah, I mean, that's one to check with your broker because every broker can do that differently. But yeah, typically that would be correct. Where do they put these videos? You know, ask the OptionsPlay folks. They will know better than I. Ask Michelle. Michelle's super helpful, or whoever, you know, they'll tell you where you can get them. Now let's hit the Q&A box here. Let's see here. Oops. This is just peachy. Oh, wow. La-ti-da. What delta should you suggest? Right. We talked about delta is not the best way to do this. I gave some tips on how to manage the Iron Condor already. Good question. That's an old one. Mark says, how do you pick the stocks or ETFs to trade? And do you have a tool or scanner to automate this process? So the stocks or ETFs I pick are range bound. They have both support and resistance. Implied volatility is elevated. But another scan or screen that I like to use is I want the bid-ask spreads to be tight. Like in Ford, like they're a penny wide. Like that's nice. In IWM, they're 2 cents wide, 3 cents wide. That's nice. My rule is for any option strategy, the offer should be no more than 10% higher than the bid. So an example of that is like these 189 puts, they're 98 cents. Let's just round that to $1. The offer should be no more than $1.10, 10% more than the bid. If you stick with that, you're gonna be making more ideal trades. Great question. Why are you looking? Okay, so why was I looking at the expiration March 18th for Ford? Because I always want to keep it under 30 days. And so I basically got 4 choices. The ones that expire this Friday, there's 2 days left. I couldn't get an Iron Condor with wide enough strikes to make sense. If I used those same strikes, I'd be collecting like a penny. It just wouldn't make any sense. I have gone out maybe an extra week? I could, and I would get a bigger premium, but then I have to hold it for a week longer. So it's always this balancing act. I want to keep the risk on for as short a period as time, but I want to get the best risk reward. I get better risk reward as I go out in time, but I have to keep it for another week. So it's always a balancing act. And you know what I like to say, Terry? I like to say, look at 3 different ways to trade it and pick the best one. How do you know which is the best one? It's the one that you think makes the most sense to you. Okay. Antonio says, should we let the Iron Condor expire worthless? No, always close it before expiration. I say always. There are some times when maybe I won't, but 95 times out of 100, I'm closing it before expiration. If the prices, Scott says, if the price is bouncing off support, can you phase in with the put spread and then sell the call spread? Yes, but I would make sure that you really like the put spread on its own first, because the stock might not bounce up high enough for you to sell the call spread you want. So you might just live with only having that put spread on. And don't overextend yourself. Don't say, oh yeah, it would be really, you know, the stock is at 90. It'd be really great if it bounced to 100 and then I sold the 110 call spread. So I'm going to sell this at the money 90 strike put and buy the, 97 strike put because I'm hoping it's going to bounce. Like, don't do that. Make sure that you really like the put spread on its own first. And if you don't get the call spread, you're going to be happy anyway. And if you do that, yeah, I've done that before a lot of times. What's the best exit strategy? 0 day. Yeah, I mean, I like to close it as soon as I can. If ever I can buy it back for a penny or two, or like if sometimes you can sit like with bigger dollar stocks, you can sell the Iron Condor for, $4 sometimes. And then if I can buy back one of the credit spreads for 10 cents, I will. I mean, if ever you can take the whole thing off for 75% of the premium you collected, it's a no-brainer. I would always do that. What is OCO? One cancels other. It doesn't come into play. I would say it doesn't come into play with this because there's too many options to be doing that. But like I just did an OCO order today on a directional play that I made. I bought calls in a particular stock. I bought calls, and after the market closed, I put it in order to sell some of those calls at a price, a limit order, good till cancel. And then I also put in order OCO, a stop to sell those calls if the stock goes down too much. Why do you do it that way? Because like, let's imagine that the stock, it goes up a whole lot and you sell those calls. Now you have no call position. But if you didn't do OCO and you also had that stop, if it goes down, now you're going to be short calls in a falling market. If you get filled on both. Daniel says, do you think the 20-for-1 stock split on Amazon will make it go up? How will that affect the options? Yeah, I mean, like in economic theory, it shouldn't matter, but it seems like it always does. So yeah, I think that'll probably make the stock go up. How does it affect the options? Also, in theory, it shouldn't, except that the stock will probably go up. But you'll have 20 options. Like instead of having one option at, what is it, a $2,700 stock or whatever, you'll have 20 at a, what is that, $100, $100 and something stock. So like it will be, you'll be indemnified, I guess. I don't know what the correct word is, but you'll have a position that exactly equals the one that you have now. The best thing, whenever you have questions like this, call the OCC, 888 options. They're the ones who make the rules, but should be fine. Are you also going short term with your regular credit spreads? Yeah, I keep almost everything under 30 days. Almost. How do you find Iron Condor trades? I mean, I'll go through charts. I'll go through charts and I'll find stocks that are in a pattern. A sideways pattern. What about close a trade at a 50% profit? Yeah, that can be okay. Like I always like to say trading's personal, find what works for you. And you know what, Arvind, one great thing to do is like, let's say you trade a 10 lot. If you take off half at a 50% profit and leave the other half run, try and get 75 or 80% profit. That's good technique too. Find what works for you. That's not a bad way to do it. Wayne says, Dan, since we can't go wrong on both sides, is it a good idea to start with a short strangle and then turn the side that's approaching a breach into a credit spread for protection? No, I don't like that. I can count on one hand the number of times in the past 10 years I traded a naked short strangle. There's just way too much risk. I mean, anybody who's been watching the market the last 2 weeks knows, or even if you haven't watched the market, you've been reading a newspaper, that, it's not it's not out of the realm of possibility that something extremely crazy could happen tomorrow and the market could drop 10%, like you could lose your shirt selling a naked strangle, especially in a market like this. So yeah, I don't like doing it that way. Plus, even if you did do that, even if like no black swan events happen, if it's a normal market, if the stock goes down too much and starts approaching your short strike, that long option you'd buy would be so expensive that like it would just screw up your entire trade, So yeah, you want that long from the get-go. Natalie says, with high volatility, would implied skew to the put side in this instance, I will short on the skew side. Yeah, so it is a thing for those of you who really look at like vertical skew. The implied volatility on the puts are more expensive typically, not on all options, but on most, than the implied volatility on the call side. But the lower strike you go, or I'm saying lower and I'm going higher, but the lower the strike you go, the higher the implied volatility. So on the put side, you're selling a put at X volatility, and the insurance one you're buying at a higher volatility. But that's just the nature of put credit spreads. You can't avoid that. John, I have OptionsPlay has asked me to come and help out its folks like yourself and give some webinars and share some things that I've been working on and studying over the past, well, I guess 29 years I've been doing this. So yeah, but yeah, like that's what I'm doing here. I'm helping out OptionsPlay as their representative today by giving presentations on some things that that I'm familiar with and that I can share with you guys. All right, Mark, see you, my friend. Will OptionsPlay ever added Iron Condor report? Yeah, I don't know, Jim. That might be another question for the good folks here at OptionsPlay. And you can ask them for sure. And that, my friends, thank you very much, Tony. So Tesla wouldn't be a candidate for an Iron Condor. I haven't looked at Tesla in easily a good week. I don't know, but if it's in a range, it could be, Tony, and if it's not, then it definitely wouldn't be. Okay. So that said, folks, hey, look, thank you so much for joining me. Hey, thank you, Tony. Thank you so much for joining me. I really appreciate you spending your time with me. And I hope that what I shared was really useful to you. You can follow me on Twitter, twitter.com/Dan_Passereli. And well, I haven't posted on Instagram in a bit, but you can see pictures of my cute little dogs on my Instagram page. And every now and then some trading stuff too. So yeah, feel free to follow me on social media. Once again, my name's Dan Passereli. Trade smart. We'll catch you on one of the next webinars. Trade well. Bye.